Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Set your agenda.
It is CPI countdown. The U.S. inflation report is just hours away. Investors are positioning for the latest clues in the Fed policy path.
Fitch gives China a negative credit outlook, saying the country is likely to pile on more debt.
And Boeing's latest battle. A whistleblower makes allegations of shortcuts in the production of the 787. Boeing disputes these allegations. Are you nervous for CPI?
I'm excited for CPI. Nervous? Get out of here. I'm ready for it, man.
Get out of here. Well, it can either fill or kill these bonds, that's for sure. Have a look at the bond market because if it prints 0.3%, is that enough of a trigger? In other words, a drop back in the core CPI. Is that enough of a trigger to cause bond yields to drop? I've just got off the IB and the feeling out there in the market is this. Today will be pivotal. We're at 60% for a June cut. We're either going to move to 40% for a June cut or 80% for a June cut because we're going to count down to the PCE in April. So crude is up by a third of 1%. Again, there is a sense out there in the oil market. We've broken 2 days of losses, even though the stockpiles have expanded by over 3 million barrels. The news line from Iran, the Iran Revolutionary Guard, says it won't block the Hormuz Strait. This is critically important when it comes to the flow of oil. JP Morgan are reinvigorating their $90 call and $100 by the end of the year. Bitcoin comes back by 0.25%. The halving is already in the price. That is according to the Marathon CEO. We just dipped back ever so slightly. Danny, good morning.
Good morning, Menace. And some of those nerves, some of that hesitation, the quietness in the market over the CPI, you're not really seeing the same in equities. It hasn't scared buyers yet. We had a late in the day rally yesterday. That's continuing through to this morning, up about 0.2% for both S&P and NASDAQ futures. Menace, this is my fun fact of the day for you because we have been moving sideways. We have gone 7 consecutive sessions now without a new record. To give you an idea of just how crazy it was to start the year, that's the longest period without an all-time high since January. That fun fact comes courtesy of Henry Allen over at Deutsche Bank. Meanwhile, NASDAQ is outperforming, perhaps thanks to TSMC, strongest sales since 2022. Europe outperforms, picking up some of the rally of yesterday in the U.S. equity session, up about 0.6%. But, Menace, it is, of course, CPI that will make a difference for these equity markets. JP Morgan says that if it comes in softer, hold on, because we'll be getting a big risk rally.
Well, hold on. I mean, nobody's as stoic as you. The point about it is whether core inflation comes in at 0.3%, does that make the January and the February readings the temporary bumps, as we've been told by the Fed? Positioning into this, and that is the critical part. You've got Bostic, of course, talking about extending maybe out to December and indeed reaffirming. I mean, he is the bear. He's reaffirming that it may only be one cut for 2024, and that could be extended right to the back end of the year. I don't think this bond market is ready for either of those facets.
But it has been moving more towards this idea that we're going to get a hot surprise, which would be the third consecutive one. And if we don't get that, though, the market does feel primed for a short squeeze. I have a chart, Menace. It's the JP Morgan Treasury Sentiment Index. This is of their client positionings. It is neutral for the first time in about a year. In other words, we're moving away from long positioning and shorts are starting to rise. Okay,
well, let's take that. And, of course, the commentary from the Atlanta Fed President, Raphael Bostic, stating this. He's open to changing his view of one rate cut this year, saying, I can't take off the possibility that the rate cuts may even have to move further out. But if there are signs of pain in the jobs market, then I'd be open to changing our policy stance and perhaps cutting sooner. Let's bring in our guest. It is Yelena Shulyatyeva. She is head of fixed income at Newton Investment Management. We'll come back to Bostic in just a moment, but let's deal with the positioning in this market. If we get a 0.3% reading on this core inflation today, could that be enough of itself to stop the sell-off in this bond market? Ella, good morning.
Good morning. I would say because the investors are probably quite nervous into the numbers, so there's some hedging that's been going on. And as you showed from the JP Morgan positioning survey, a lot of the longs have come off. So perhaps in line to slightly softer would be good enough for risk markets and certainly support the bond market temporarily. But the truth remains that data is strong, right, on services, on the core components, and the economy is still running at a decent momentum. And so basically, and you still have a good amount of cuts still priced in the year ahead for the Fed. And so there's still some more damage that we can do, given that we are starting to shift away from the more benign base effects on inflation. So from this month onwards, base effects start to wear out. So the risks are still there, I would say. So perhaps we might get a temporary respite, but down the road, I don't think a lot would shift. It's just more a case of can the Fed deliver sooner on those cuts.
Does that mean that there's nowhere in this Treasury market to buy, Ella, if the risks are still there?
We have been in favor of the steepener trade, absolutely, and I think you have a bit more protection in the short end of the curve. I think that sort of bias where they're keen to cut still, or at least deliver at least 2 cuts this year, would support shorter dated maturities, would support some of the credit markets. It's just a case of what happens out in the curve. So I think with this backdrop and a Fed that hasn't fully shifted away from its more dovish stance, then I think you probably are safer staying in the shorter maturity bucket rather than out in the curve.
What are 2 rate cuts, or even if Boston? What the risk is this: we seem to be fighting the tide in terms of rate cuts. I just wondered to what extent is the bond market prepared for 1 cut, and it to come as late as December?
Well, I would say probably better prepared than it was in January, right? So we came into January with a huge positioning and obviously on the back of a big rally from December. So there's still more momentum to go. I would say, technically speaking, the pressure is still for higher yields, right? So if you look at the way we're trading, we're sort of making higher lows in terms of ranges. And so the risk is still higher, and we have been more cautious with that view in mind. So you can do more damage. But of course, I think bonds would be a little more sensitive to growth data, and we've just not had enough of that coming out of the US. So for now, I think the momentum remains for yields potentially higher.
Ella, one of the most read stories on the terminal this morning is about CPI, but it's more CPI adjacent. It's this idea that there was a worker at the BLS who had this group that he at least labeled in his email as super users, the likes of BlackRock, JP Morgan, some hedge funds, some research firms, basically corresponding with them, helping them out with the data. But the BLS has come under scrutiny for this, themselves saying it's an embarrassment. We've talked a lot about this idea that the data is not extremely extremely reliable as one would hope. What does it mean as someone who's trying to interpret this data, trying to use it into their investment strategy, when you have a knock of reputation to the BLS, to the very agency putting out the data?
Well, I'm definitely not on the recipient list, I can say, of that information. But no, I mean, I think information asymmetry is a problem, but it's existent in markets. I don't think that's any news. You know, there's always additional color that's sought from additional analysis. So potentially a little bit of an embarrassing story. But I guess it's very difficult to do our job with just one piece of information, I suppose. We're always looking for a mosaic of pieces of information. And so I'm sure this too shall pass, if I may say.
Well, it's certainly one of the most read stories, but then for time immemorial, there's been privileged access when Fed and various officials turn up at various events. It's about insight and access. Ella, the commodity shift that we have seen in gold and a number of other commodities, you say that tells you something not so much about inflation hedging, but about real rates.
Yes, I think, it's a school of thought. Obviously, it's an opinion. That's what makes the market. But I guess one of the triggers potentially it's signaling is that the anticipation in the market is either that this central bank will cut or will ease into potentially an accelerating cycle, especially on the inflationary side. And so you're buying some protection to that. Or that the end game is eventually that real rates need to be suppressed significantly because we just cannot withstand rates that are substantially higher for longer. And I think that's, commodities and particularly gold offer you a way of hedging some of that risk. So it does make sense. It's not irrational to assume that.
So when it comes to the Fed versus the rest of the central banks, Pictet and Jupiter figure that the market is being too sanguine on what the BOE is going to do. They say that there is a risk that the BOE goes faster and cuts more deeply than the Fed. And the market is underappreciating that. They say versus the Fed and the ECB, and therefore gilts look attractive. Is that a trade you'd want to put on, Ella?
Yes, we've been actually running a long in gilts position, and it's exactly for the same reason. We're a little bit less constructive on the European bond side, and that's because we think enough cuts are priced in, and it's very negative carry to run longs in bonds. We believe they're actually rich. But in the case of the UK, that's true. We have sort of taken profits on half of that position, I might say, predominantly because that ran quite a while. So from here, I think you need to be a bit more cautious, but still, structurally speaking, there's a bit more weakness in the UK consumer story, who gets hit both from higher mortgage rates and certainly this bite that comes through the cost of living crisis, which has ameliorated but still remains a pressure point for the UK consumer.
How important or how revealing will the minutes be today for the Fed?
I think they're essential in the sense they'll give us more of a sense if we're shifting from this center, which was very much about wanting to go with the Taylor rule, so deliver those cuts that the Taylor rule was suggesting. So we'll get a sense if there's a bit of a wobble around that. Mm-hmm. My view as a bond investor is there should be a bit of a wobble because we've had incremental pieces of information that tell you they should be backing away a little bit here. But my read of the Fed is they're very keen to cut, right? And so as we have learned the lesson in the market, don't fight the central banks, but there are some times when you have to, right? Yeah. So it remains to be seen, but my read of them is they are very keen to cut. So they'll latch on a sort of a fairly benign CPI print to do just that, right? Because of course we have elections coming up in November, so you don't want to steer too close to the elections. But at the end of the day, let's see what the minutes tell us. Let's see what inflation tells us. But certainly the direction of travel seems to be a little bit more in the be careful camp, I would argue.
Yeah. I know you say don't fight the Fed, but Ella, we know you have a little bit of that bond vigilante streak in you. Ella, thank you so much for joining us this morning. Ella Hoxha of Newton Investment Management. Okay, Manis, let's get to some of the other top stories that are trending on the terminal this morning. Intel is rolling out a new version of its AI chip. It's aimed to challenge NVIDIA. The updated processor called Gaudi 3 will be widely available in the third quarter. The chip is designed to boost performance in two key areas, helping train AI systems and running the finished software.
At least 3 people were killed after an explosion at the Enel hydro power plant in northern Italy. The explosion occurred as maintenance work to renew the facilities at the 1970s era plant were concluding. Prosecutors say they will open an investigation into the responsibility for the accident, with a possible focus on the contractors hired for the renewal of the plant's turbines.
U.S. Ambassador to Japan, Rahm Emanuel, says the Biden administration is looking to reverse China's attempts to isolate countries in Asia with help from Japan and other allies. Emanuel spoke to Bloomberg in Washington ahead of a summit between Biden and Japan's prime minister.
China's whole strategy is to isolate the Philippines, isolate Australia with their economic coercion, isolate Japan by not accepting their fish to be exported. Our strategy is to flip that script and make the isolated party China. They're the ones that are isolated in the South China Sea as it relates to the Philippines. They're the ones that are isolated when it comes to trying to use economic coercion to coerce Australia to change their posture. And they become the isolated party, which is why they throw in the towel on that effort.
Coming up this hour, negative outlook for China from Fitch Ratings. We discuss the details.
But first, up next, shares of Boeing hitting the lowest level in 5 months. The company faces a deepening crisis. More on that next, here on Bloomberg Brief. It's Bloomberg Brief with Danny Berger and Manis Cranny in New York. So shares of Boeing, Manis, they fell to their lowest level since October after an engineer at the plane maker alleged that it took shortcuts in manufacturing 787 Dreamliners. The whistleblower says on a conference call that, quote, in a mad rush to reduce the backlog of the planes and get them to market, Boeing did not follow on its own engineering requirements. Now, Boeing, for its part, has rejected the allegations, saying that the claims are, quote, inaccurate. Bloomberg's Benedict Campbell joins us now for more on this. I mean, Benny, this was a whole production. It was a whistleblower with a lawyer, a news press conference, and pretty damning claims, again, which Boeing has disputed about the Dreamliner. What exactly were those claims?
So these claims came out last night. We were on a conference call with other reporters and with the lawyers and the whistleblower, who interestingly remains an employee at Boeing. This is somebody who's worked on the 787 Dreamliner program. Just to give people some context of the plane, we've talked a lot in the last couple of months about the 737. That's the smaller, narrow-body aircraft that had that incident at the start of the year. This is the larger plane, the 787, that's used for long-distance travel, and it's built in a slightly different way because it's made of composite materials. You have these big sort of barrel sections that need to be pieced together, and there will be small imperfections in the way that these pieces are put together, and engineers then have to look at these and need to make fixes. It's called shimming, and the allegation now is that they didn't follow this process properly. They cut corners, they were sloppy, they tried to rush these planes out because these small fixes are fairly complicated and time-consuming, and that was time that the allegation goes Boeing didn't want to spend and therefore rushed the planes out, and that might, over time, compromise the structural integrity of the aircraft.
Yeah, I think the language used was wrongly measured, filled gaps. They were in a mad rush to reduce the backlog of planes. How can Boeing regain any upper hand narrative in this? They can defend the processes, they can defend the allegations. They are in some kind of literally a vortex of bad news and reputational injury at the moment. How do they change that narrative?
Well, you're absolutely right. They're in a real funk at the moment, and this started around, that accident that I talked about at the start of the year, and it's just getting progressively worse. With this, they are furiously pushing back on these allegations, saying this is wrong. We have fixes in place. They don't dispute that the 787 did, for some years, have some manufacturing issues, but they say that we went to great lengths to fix these. We put processes in place. We haven't put sort of profit over process and speed over safety. But that is very much the allegation and the public concern that sticks. So they have to change that narrative. How do you do that? Probably with a new CEO, Dave Calhoun, who remains in place at the moment, but is essentially on his way out. He will have to make way for somebody new, and that person really needs to reset the tone of the company. They need to regain the upper hand of the narrative, put engineering excellence first, put manufacturing first, put the products first, forget about financings, forget about making money, as hard as that might seem, but that really is where they need to go, because as long as you'll have people in the public wondering, do I want to board this aircraft, looking at what kind of plane it is they're on, that's as long as that problem won't go away.
It is allegation after allegation for Boeing. It is difficulty in their earnings. It keeps stacking up. I mean, does this not light a fire under them of we need a new CEO and we need it now?
You're absolutely right. They do need that person sooner rather than later. Calhoun has said he will stick around until the end of the year if needed. I would bet that he will leave far sooner than that because the problems are so vast and the challenges are so big. They need that new person now. There's no obvious name out there right now, but I'm sure the board is furiously looking for that candidate. And the moment that person is named, Calhoun will step aside, and that person will have a huge task on their hands. But it's also, if they can turn this around, this is the big turnaround story in the corporate world right now. If you can get this right, then you're in the sort of pantheon of great CEOs. So massive challenge, massive millstone, dare I say. But again, if you're up for that, this is the job you want.
Okay, well, they're certainly up against it, and the debate is now going to be whether Calhoun can make it to the end of the year, because confidence is everything, and that's sadly lacking at the moment, despite the denials. Benny, thank you very much. Benny Camel there on the very latest Boeing woes right here on Bloomberg. Good morning from New York. It's Bloomberg Brief. I'm Menace Craney alongside Danny Berger in New York. Now, ByteDance, it's the name of a company that invokes spirited response on Capitol Hill. But of course, its profits have jumped by 60%. It's taking a bite, excuse the pun, taking a bite out
Nice.
of Tencent and Alibaba. I mean, this is a ferocious move higher by ByteDance, the owner of TikTok, for anybody in the world that does not know.
Not only has it taken a bite, Manus, it is dancing.
You like that, didn't you?
It is dancing on Tencent.
Oh,
if I can feign the puns even more. It's the first time they've overtaken Tencent in terms of revenue and profit. It just shows the behemoth that ByteDance and TikTok have become. And for Steve Mnuchin and those who are hoping that Congress tells them you need to divest your U.S. asset, I mean, they want to get their hands on this thing.
Yeah, I mean, who are the investors? Have they got the capital? Will ByteDance split off the U.S. business? Will they give the intellectual data across? ByteDance also cut hundreds of jobs last year. I mean, they're not all of tech was under a bit of pressure last year, but they cut hundreds of jobs in their gaming division, in the enterprise software divisions as well. So they've already front-run some of that job-cutting narrative in the tech space as well.
Yeah, and for what it's worth for everyday people to get their hands on this, I mean, that long-awaited IPO keeps getting delayed, concerns about,
it's worth a lot less now.
Yeah, but I mean, people would still, I think, jump on that IPO, I am sure, but will it come to fruition?
Danny's big on TikTok. So am I.
We try our best.
We'll talk more about the CPI in just a moment. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
We are on CPI countdown. The U.S. inflation report is just hours away. Investors position for the latest clues on the Fed's policy path.
Fitch gives China a negative credit outlook, saying the country is likely to pile on more debt.
And Boeing's latest battle. A whistleblower makes allegations of shortcuts in production of the 787. Boeing disputes these allegations.
So, Manus, the longs are getting wiped out of this market ahead of the CPI, but do you think the stock market cares?
Nah.
Nah. The bulls...
It's immune.
Yeah, the bulls are bullish as always. I mean, we are up only ever so slightly. It is worth mentioning, even though stocks have held up while we've seen wobbles at least underlying this bond market, we've been moving basically sideways. We do that again this morning. S&P up just 0.1% after that late in the day rally yesterday. NASDAQ futures, those move up by about 0.1%. A bit of outperformance, perhaps helped by TSMC. Really strong earnings. The American ADRs up about 1% or so. There you go on your screen. They're up 1% this morning. But we are in this moment where we haven't set a new record for the past 7 straight days. According to Deutsche Bank, that's the longest streak we've seen without a new record since January. So the momentum of this market has certainly cooled down. European equities up 0.6%, Manus.
Well, they're nervous in the bond market, that's for sure. We're going to see what this CPI print is. We're expecting plus 0.3%. That would be a slowdown from the bumps and the anomalies of January and February. Right now, 435 is where we are on the bond market. Bostic wants full optionality. He talks about the possibility of one cut pushing it into the last quarter, a robust U.S. economy. There was a massive option trade that went through, the biggest options trade ever in the history of options at the short end of the curve, 75,000 block trade. We are assuming that it was a buyer of that at the long end. We've got some more auctions coming through today. The 3-year auction, they had to cheapen that up yesterday to get it away. $39 billion worth of 10-year paper coming today. Crude is up by 0.25%. We're breaking 2 days of losses. The news flow from Iran, by the way, the Iran Revolutionary Guard says it won't block the Hormuz Strait. That's important. Golnar Motovali breaking that news flow down from Iran yesterday. JP Morgan has $90 on the table for crude by May of this year and $100 by the end of the year. Bitcoin slips by 0.1%. It's hardly a huge move. The sentiment is that the halving is already, that halving event, halving the amount of Bitcoin that will be available is already in the price. Danny.
And another question of what's in the price is hotter inflation in the price? We were just speaking to Ella Hoya of Newton Investment saying that, sure, you could get temporary respite if the CPI comes in softer with a bond market rally. But to her, that is not going to last. That ultimately the pressure for this bond market is yields higher. She
did say more damage to come in this market, and that the pressure, as you say, it's going to come down to, and this is what we're going to discuss in just a moment, the elements of supercore. In other words, those rent elements, used cars, what is going to go on in that rental market. That is going to define whether January and February were an aberration. And whether we're returning to some kind of more normalized disinflation narrative.
Well, Powell himself said in the last conference, it is too soon to say whether the recent readings represent more than just a bump. So is today more than just a bump. And investors are bracing for that data. Manis, to be specific of what we're expecting, forecasters are expecting some moderation following elevated inflation readings to start the year. Joining us now to get all into this, it's Yelena Shulyatyeva, senior U.S. economist at BNP Paribas. Yelena, I was saying to you during the break that I've had it seems like a flood of notes in my inbox saying that 0.3% consensus is too much. Bank of America just had a note out saying they think it's around 0.2, a little bit stronger than that. So where is my tail this morning? Is it inflation that comes in stronger or weaker versus expectations?
We had 0.3% on core, but there are reasons to believe it could be higher, it could be lower. So I think, if you look at core goods prices, we may see some decline there from used car prices. But there are reasons to believe that January and February was an aberration because, if you look at services ISM index, for example, that went up sharply in January for prices paid, and then that went down. So it looks like there could be some aberration in January, and that means inflation is decelerating into the spring months. But we could see some risks from shelter inflation. That's an upside risks. There's been a constant tug of war between supply and demand in the housing market, and housing prices are still very high. That is putting an upward pressure. So this morning, we're going to see 0.3% in our view. There are reasons to believe the risks are to both sides.
There seems to be a growing acceptance of slightly higher bandwidths of inflation will be tolerated and still allow the Fed to cut. Is that a narrative that you subscribe to?
I don't think so. They still believe in the 2% inflation target, I think. But you're right.
But there's a heck of a distance to go between believing in 2% with a core inflation PCE way ahead of where that target is. If we're going to go off core PCE, they won't be cutting this year.
I would answer with a question. Would you, if you were Chair Powell, would you really bang on the table and say 2%, 2%, if you see the economy is doing great and you don't really want to really damage it, right? So if, say, we are getting closer to 2%, but not there, I think they will be a little bit softer on that.
It's fun. I want to game this out of what would happen if Manis occupied the body of Chairman Jay Powell. He'd wreak havoc. Jay Powell shows up with an Irish accent, mass confusion everywhere. That'd be great. So, Yelena, we also, it's sort of in this idea of optionality. We heard from Bostic, he was speaking to Yahoo yesterday, and he kind of said everything someone could possibly say. He said, I can't take off the possibility that rate cuts may even have to move further out. But if there are signs of pain in the job market, then I'd be open to changing our stance and perhaps cutting sooner. To me, that sounds like we could literally do anything. We could hold, we could cut, we could hang around.
Totally data dependent.
Yes.
And this is what has been the narrative recently from everybody. Yet it feels like from the recent Fed speak that they are ready to start that cutting cycle. We don't necessarily call it an easing cycle, but they just want to get things going to make sure that the real Fed funds rate doesn't rise further and really they over-tighten policy too much. So there are some parallels to the mid-90s there. So Chairman Greenspan saw this big productivity boom and growth really being strong without additional inflationary pressures. So we are a little bit in the same boat right now. But right now it seems to be driven by labor supply more than productivity. But still, we can have strong growth, strong labor market, and some deceleration in inflationary pressures. So that means the Fed may start cutting rates. They don't have to go at each and every meeting or each and every quarter. They can start, pause. That's what happened in the 90s.
Bostic talks about a robust and strong and resilient U.S. economy. And with that in mind, do you see 2 rate cuts as being ensures the Goldilocks scenario and the nice soft landing of this economy, but then cast forward into 2025? Who knows where we're going to be in a couple of months. But this cycle of cuts, if you believe you've got a higher neutral rate, the cycle of this cuts, the scale of cuts in this cycle will be much less than a traditional cutting cycle.
Totally. I think we are at 3 cuts. This is our official projection. But I think it's obviously less than they would do in a recession type scenario. This is an adjustment cycle, cutting cycle. So, and this is what the Fed has in mind. As the economy is still growing, they just don't want to overdo it. They just want to adjust the level of rates so that they achieve soft landing.
Yeah. Well, speaking of this idea of insurance that Manis was kind of hinting at, we're going to get FOMC minutes today. I know you noted that the important thing for there is any details about QT. Is that something that also needs to be sped up? Well, not sped up, wound down, QT, but having that done sooner because of this idea that, sure, we're not seeing market stress now, but we need that insurance should it start to crop up?
Well, they want to start QT tapering so that they get it on the way and prolong that QT tapering cycle. And again, right, to alleviate any funding pressures and things like that. So our projection is that they will announce the details sometime in May and start Q tapering process in June. In terms of the minutes, in terms of the rates policy too, I think it's important to watch how many, and we're going to count those many and several and some words in there.
So hopefully you have an AI bot to do that for you, Yelena.
So how many of them are feeling that they need to move to a higher rate in terms of the S&P projections? Because yes, the median is at 3 rate cuts, but there are a lot of people above that. And we just want to get a sense of how that is going. And also, I would like to see if there's a very broad support for supply side of the economy drivers. So we heard that from the chair. We heard from other Fed policy speakers that the economy is really supported by immigration, by population growth, participation. Is there broad support for that type of narrative in the minutes?
Do you think this bond market, Danny had a great chart at the start of the show talking about the neutrality, the overall neutrality, the JP Morgan survey, overall neutrality. There has been incremental adding of shorts into this number. Do you think that there's more damage, to quote Ella from a little bit earlier, that there could be potentially more damage on the upside in yields if it's an at-the-money inflation print of 0.3% today?
I think 0.3 inflation print will be good for everybody. That would just mean that the Fed will, do what they are intending to do. And at the end of the day, that would tell me that it is really getting to a soft landing scenario.
Okay. Goldilocks will be happy. The porridge will be grand. Yelena, thank you so much for being with Danny and I this morning. That is our guest. Ahead of the CPI, Yelena Shulyatyeva at BNP Paribas. Coming up on the show, negative outlook for China, this time from Fitch Ratings. We'll explain the details behind the cut. It is Bloomberg Brief. I'm Menace Crenny alongside Danny Berger in New York. So Fitch has revised the China outlook to negative, citing the nation's debt burden. This as it seeks to pull itself out of economic slowdown. Now, this comes as a similar move from Moody's in December. The Chinese government pushed back on the downgrade, saying that it failed to reflect the role of fiscal policy in shoring up growth. Alan Wan is with us from Shanghai. Alan, why did Fitch take the action now?
Yeah, I mean, that's a really good question. I mean, it was just a matter of time. Like you mentioned, Moody's did the same thing back in December, and things haven't really changed a whole lot. I mean, the property slowdown is going to hurt the Chinese economy, which in turn is going to force the Chinese government to increase fiscal spending, which, of course, was going to blow up debt. If anything, the timing is a little bit unusual just because it looks like things are starting to turn up, improve in the Chinese economy. There's some anecdotal evidence. Stock market is starting to bounce back. And we've got a bunch of economic data coming up next week, such as first quarter growth. That's probably going to show things possibly improving from where they were several months ago.
Alan, presumably all of this is just priced in. I mean, this is not exactly new information, as you put it, that China is taking on a lot of debt.
Yeah, I mean, that's right. But the reality, too, is that, and the government said it as such, that the ratings agency is not really considering the fact that by taking these actions, it's going to shore up the economy, and that's going to stabilize China's debt burdens. And China's debt burdens, I mean, how bad are they? It was 80% of GDP last year, middle of last year, which seems high, and it's high compared to where it was a decade ago, but it's lower than like other advanced economies like the U.S. and Japan.
Well, debt is certainly a hot topic in this country as well, so there's no irony lost on anybody in this debate. Tell me this, Alan. President Xi, he's got a meeting with the president of Taiwan. What's the upside? What are they looking for from this meeting? What does Xi want to achieve?
Well, you know, I think it's a lot of symbolism, a lot of peace symbolism. I mean, you have to understand what's going on right now, right? In Washington, the U.S., Philippines, and Japan are going to meet to discuss their concerns about China's growing assertiveness. Next month, you've got a new administration in Taiwan. Their leader has been called a separatist from some Chinese officials. So I think that it's more optics domestically, just to show that China is capable of talking to its counterparts in Taiwan, but not necessarily this particular administration.
Okay, Alan, thank you very much. That is Bloomberg's Alan Wan in Shanghai. Now, speaking of Taiwan, TSMC's sales grew at its fastest pace in more than a year, all thanks to, you guessed it, the boom of AI development. They're, of course, the world's most valuable chip maker, and they may now return to solid growth this year. Joining us now is Bloomberg opinion columnist Tim Colpan. Tim, I mean, these are some pretty nice chunky numbers for TSMC.
Yeah, especially consider that they had a decrease in revenue last year. So first quarter numbers, double-digit percentage growth for the first quarter already. They're looking, they've already forecast that they will have solid growth this year. So this augurs well for a very solid year ahead. And as you say, it's all about AI, NVIDIA, AMD, even Intel are putting in a lot of energy to create new AI chips. And they're sending those designs here to Taiwan, to TSMC to make them for them.
Their AI revenue is growing at 50% annually. There you go. That's all the bots needed to see. There's the ADR up 1/10%. Tell me this. We've talked about the incentives, the loans, and perhaps the incentives the Biden administration are about to give TSMC to build factories here in the USA.
Yeah, well, they're getting as much as $6.6 billion in incentives from the federal government, which sounds nice, and I'm sure TSMC is happy to have it, but they are committing $65 billion. So TSMC would actually probably like to see a lot more than $6.6 billion as kind of a payback or a kickback or an incentive from the US government. There is actually some tax incentives as well that need to be calculated, which could add a few more billion onto that. But, you know, it really is a drop in the ocean compared to the amount of money they're spending in the US. And remembering that the US is a much, much higher cost base for TSMC to operate than Taiwan. So when they do get going and they do make chips, they're going to be a lot more expensive than they can make in Taiwan.
Huh. Okay, that's interesting. So in terms of other sort of following the production line type stories, we have these numbers from Apple that their output from India has hit $14 billion. And Tim, I guess the reason that this is significant is it's just another notch in this narrative of Apple moving away from China and into India.
Yeah, I mean, it's so easy to fall into the trap that India is the next China. Of course, it's not, but there is quite a few similarities. And one of them is the fact that India is taking up a lot more of the electronics manufacturing. Companies like Foxconn, Wistron, Pegatron, and many more are expanding in India to make devices for companies like Apple. So we're going to see that number grow year over year for the next many, many years. The key for Apple and many other companies, though, is will India replace China in terms of consumption? China is a very big consumer of phones and all sorts of other electronic devices. India is growing, but you know the demographics of India are very different. So the challenge for companies like Apple will be to find new growth markets to buy their products, not just places to make them.
Yeah, well, it certainly comes off the back of Yelena's trip there, talking about all of the issues around domestic and international, let's say, supply and demand from China. Tim, thank you very much. Great context this morning on TSMC and Apple, our Bloomberg opinion columnist. Now, if you are out there and you've got your Rolex on, the question is, have you got the right Rolex on? Because we've got our Bloomberg sub-dial index flat for the year. sorry, flat for the month, I should say, down 9% for the year and down 42% for the year. But not all Rolexes are created equal, are they, Danny?
I was going to say, look at your watch. If you've got the Rolex, that's the blue and the red, aka the Pepsi, or the one with the green bezel, aka the Starbucks, congratulations. There you go. There's the Pepsi. Congratulations. You have a watch that has gained in value. It's so hilarious to be talking about this because the CEO of Rolex, oh, by the way, this is the Batman. This one, I'm sorry, it is flat.
You like this?
This one, I like this one, but it has
you
not
pay
gained
more
in
for
price.
that?
Maybe, I don't know.
20,000, what is it, $20,000 for the Pepsi, the regular Pepsi, $21,000 if we're being generous. But of course, if you got the Submariner, poor man's Rolex, is it?
Poor man's Rolex. If you got the Patek Philippe, which is probably the rich man's Rolex, that gained more than 1% to go at $98,753, Manus. I'll have one for Christmas. Thank you very much.
She'll have one for Christmas. There you go. If anybody's got a Patek 5711. By the way, you can go on Poshco at the moment. Just having a look. We've got a few Rolexes on there. A little bit of Gucci. We've got a Rolex GMT ceramic root beer. $17,250. I'll give you an ID later on.
But you know, we're not supposed to be talking about this. Remember the Rolex CEO, wasn't it just yesterday? He said,
do not equate these assets to stocks.
Yes, exactly. These are not stocks. They're not investments, which, again, I still don't understand because I think more people would buy watches if you say, hey, these might go up in value.
There's quite a few people have heavily invested in watches and have a reasonable exposure to these. And of course, to make your watches, you're going to need a little bit of commodities. One small portion of that is gold, which is careering through records. It comes back a little bit this morning, Danny. But of course, it is down to central bank buying. We know that.
Yes.
And a whole host of other moves in the commodities.
Yeah, exactly. We are looking at copper LME up about 0.7%. It is trading at the highest level in 2 years. Middle East tensions continue to simmer. Your NYMEX crude at $85 a barrel. This is Bloomberg. It's Bloomberg Brief. Danny Berger and Manus Cranny in New York. All right, let's get you set up for your trading day. Here's a look at what's ahead. It is a big day on the inflation front. CPI comes in about 2.5 hours, 8:30 a.m. Eastern. Then Chicago Fed President Austin Goolsbee will be delivering remarks at 12:45 p.m. Eastern. Then we get the FOMC minutes. Those will be released, of course, at their last meeting at 2 p.m. Eastern. Manus, it's about two things, just what the divide is on rates and at the same time what they're going to say about the pace of winding down QT.
Absolutely, and 0.3% on the core. What is the owner's equivalent rent? That is going to be the core part of the discussion. A little bit later on, we'll bring you through that here on Bloomberg. Some stocks to keep an eye on. Alphabet rises as Google unveils a host of updates on the AI side and at their annual cloud conference. Then you've got Trump Media down by nearly 2%. This is the co-founders are now challenging that 6-month lockup period and their ability to sell this stock, and they're claiming it's done irreparable harm to them. Tesla is up by 0.5%, reportedly in early discussions with Reliance about a possible JV to build a manufacturing facility in India. Danny.
All right, you got 2.5 hours, just a little bit more than that, to brace yourself. Go get that cup of coffee. Get yourself ready for CPI. 0.3% is the estimate for month over month.